Everyone wants to know the one stock to buy, the one fund that finally makes them rich. But the biggest driver of how your money actually grows is not the thing you obsess over. It is a decision most people never consciously make at all. It is not which stock, it is the mix, how you divide your money across different kinds of investments. Today, asset allocation and diversification, the closest thing investing has to a free lunch, and the single most important skill nobody ever taught you. Welcome to Fiscal Fluency, the language of wealth. Building a portfolio can feel like it needs a finance degree and a Bloomberg terminal. It does not. Let's translate it. What asset allocation really means, why diversification quietly works, how to set your own mix, and the one simple habit that keeps it all on track. Start with the term. Asset allocation is simply how you split your money across the major types of investments: stocks, bonds, and cash. That is it, and here is why it matters more than almost anything else. A landmark study by Brinson, Hood, and Biebauer looked at large pension funds and asked one question: what explains why a portfolio's returns swing around so much over the years? The answer was not which securities they picked. It was not market timing. More than 90% of that variability traced back to one thing: the allocation, the mix itself. So while everyone else argues about the perfect stock, the professionals are quietly obsessing over the recipe. Now, diversification, and why it is so much more than don't put all your eggs in one basket. The real engine underneath it is something called correlation, whether two investments tend to move together or apart. Picture two assets with the same expected return. Held alone, each one is a roller coaster. But if one tends to rise while the other dips, holding both smooths the ride. The peaks and the valleys partly cancel out. You get a similar return with far less violence along the way. In 2008, as stocks collapsed, high-quality bonds actually rose. The ballast did its job exactly when it mattered. The economist Harry Markowitz won a Nobel Prize for this insight and famously called diversification the only free lunch in investing, because it is the rare case where you lower your risk without giving up your reward. Stocks zig, bonds often zag. That is the whole point. So what are you actually mixing? 3 core building blocks. First, stocks, your growth engine. Over long stretches, they have delivered the highest returns, but with the wildest swings. Second, bonds, the ballast. You are lending money out in exchange for interest. The returns are lower but far steadier, and they often hold firm when stocks are falling. Third, cash, savings, and money market funds. Almost no risk, instant access, but after inflation, it barely treads water. Some investors add satellites, real estate, or a slice of international stocks. But stocks, bonds, and cash are the foundation. Think of it like a team. You would not field only strikers. Each block plays a different role: growth, stability, and safety. So how do you choose your weights? 2 dials, your time horizon and your stomach for risk. The longer until you need the money, the more you can lean into stocks because you have years to ride out the crashes. One old rule of thumb: 120 minus your age as your percent in stocks. At 30, that is roughly 90% stocks, 10% bonds, aggressive because you have decades ahead. At 60, closer to 60-40, more ballast because the money is needed sooner. It is not a law, it is a starting line. The honest test is that second dial. If your portfolio dropped 30% next year, would you calmly hold, or would you panic and sell at the bottom? Pick a mix you can actually stay invested in. Notice that your mix should not stay frozen for life. When you are young, the goal is growth, so you tilt hard toward stocks. As you approach the finish line, retirement, a house, whatever the goal is, you gradually shift toward bonds and cash to protect what you have already built. That slow drift from growth to preservation has a name: the glide path. It is exactly what a target date fund does automatically. Pick the year you plan to retire, and the fund quietly dials down the risk for you, year after year, all on its own. You can absolutely do it by hand, too. The principle never changes. Take more risk when you have time to recover from mistakes, and less as the deadline draws near. Here is the habit that ties the whole thing together. Rebalancing. Say you choose a 70-30 mix, 70% stocks, 30% bonds. Then stocks have a great year and grow much faster. Quietly, without you touching a thing, your portfolio drifts to 80-20. That sounds like good news, but you are now carrying more risk than you actually chose. You did not decide that. The market did. Rebalancing simply means selling a little of what grew and buying what lagged to steer back to your target. It feels completely backwards, trimming your winners to top up your losers, but it quietly forces you to buy low and sell high on autopilot. Once a year, or whenever your mix drifts more than about 5 points, nudge it back. That is how you keep the exact risk you signed up for. And here's the relief in all of this. None of it requires 40 different funds. Diversification is not the same thing as complication. A classic 3-fund portfolio, a total United States stock fund, a total international stock fund, and a total bond fund already spreads you across thousands of companies and governments around the world. Or, go simpler still, a single all-in-one fund that holds the entire mix and rebalances itself for you. Piling up a dozen overlapping funds is not more diversified, it is just messier. There is even a nickname for it, diversification. The goal is broad, cheap, and boring. A small handful of index funds held for decades quietly beats most of the frantic activity swirling around them. So here is your new vocabulary. Allocation, the mix. Diversification, spreading out within it. Rebalancing, keeping it honest. And 4 questions to set your own. What is my time horizon? What is my true tolerance for risk? Am I spread across asset classes, not just across many stocks? And am I rebalancing? This is education, not financial advice. Your mix is personal, so consider a fee-only advisor if you want a second read. If this made investing feel a little more fluent, subscribe and go build a portfolio you can hold for decades. Stay fluent.